Landlords know that real estate helps to reduce tax exposure, but you may not know that if you qualify as a real estate professional, you can pretty drastically reduce your tax bill by writing off an unlimited amount of passive losses. I'm Brandon Hall, CEO of the Real Estate CPA. Today, I'm going to give you 5 tips on how you can qualify as a real estate professional. Before we get started, make sure that you subscribe to our YouTube channel. You'll be notified of future content releases. And if you like what you're hearing, check us out on a virtual workshop at www.therealestatecpa.com/virtual-workshop. The first tip is to understand why qualifying as a real estate professional is important. Under Section 469 of the tax code, the general rule is that all rental real estate activities are passive, which means that the passive losses can only be offset by other passive income. There are 2 exceptions to this rule. The first is that if your modified adjusted gross income is below $100,000, you can take up to $25,000 of passive activity losses against your other income. If your modified adjusted gross income exceeds $150,000, that loss allowance is phased out, which leads to the second exception of potentially treating those passive losses as non-passive, and that's qualifying as a real estate professional. If you currently have passive losses that have been suspended on your tax returns, comment below with yes. If not, comment no. This will help me create better content for the future. So the second tip that I have for you is just how do we qualify as a real estate professional? First, we have to spend at least 750 hours in a real estate trade or business. Second, more than 1/2 of our time spent in trades or businesses must be spent in a real estate trade or business in which you materially participate. If you meet these 2 tests, you qualify as a real estate professional. But it's important to note that qualifying as a real estate professional does not automatically allow you to deduct your passive losses, because all you've really done is overcome the presumption that your rental activities are passive in nature. And that leads me to the next tip. Tip number 3, you have to materially participate in your rental activities. And before we get into the actual quantitative tests of material participation, I first want to tell you what hours do not count. And those hours are investor hours. Activities that qualify as investor hours are reviewing financial statements, preparing investor reports, managing finances, and researching new properties. Now, there are 7 tests to material participation, but the ones that we most often see are that you spend 500 hours in your real estate activity. Your participation in the activity makes up substantially all of the participation in the activity during the year, or you participate in the activity for more than 100 hours during the tax year, and your participation is not less than that of any other individual during the tax year. So if you are a real estate professional and you can demonstrate material participation, you can now write off an unlimited amount of your passive activity losses against your other income. But an issue that a lot of landlords have is that they have multiple properties. Material participation is looked at on a per property level, meaning that you have to demonstrate that you materially participated in each individual property as a separate activity, unless, that brings me to my next tip. Tip number 4, you can elect to group your rental activities together as one rental real estate activity for purposes of meeting the material participation hour requirement. And while this aggregation election might make it easier for you to meet material participation hour requirements, it definitely has its downsides. For example, once you make the election, when you sell a property in the group, you may not have sold substantially all of the real estate activity, and as a result, you may not be able to claim passive losses allocated to the rental property that you sold, if any exists. And this can obviously create a lot of tax problems if it's not planned for in advance, so do be sure that you consult a CPA before you make any sort of aggregation election. Tip number 5 is that you need to issue 1099s if you qualify as a real estate professional. You need to issue 1099s to anybody that you paid more than $600 for services performed during the year, with the exception being that you don't have to send a 1099 to any corporation unless they are related to medical or legal services. Thanks for watching. Make sure that you comment, like, subscribe, and share this content with everybody that you know. I really appreciate it.